A major change is on the horizon, which is going to change the way you use your money. So, what do you need to know to get yourself prepped and ready? The US Federal Reserve is expected to cut interest rates as early as September 2024. This will make the cost of borrowing money cheaper. That could mean lower rates for home or car loans.
So what happens when the Fed rate drops? It will affect the Singapore interest rates as well, because interest lending from financial institutions to consumers is a business. And when interest rates are high there, interest rates will be high here, and interest rates are low there, we have to reduce interest rates here as well. If not, the financial institutions, nobody will borrow from them, right? They will rather borrow from elsewhere. So the Fed rate has consistently shown patterns which, when it drops very quickly, and when it stays high, it only stays high for 3 years. This is the end of the third year. So it will drop next year. And when it drops, it should drop quickly.
Definitely, it feels like rate cut is going to happen. How will that affect Singapore? Because Singapore it's quite easily influenced by interest rates from other countries. The immediate impact if the US were to do a rate cut will definitely be the prices of US goods will be going down. So probably MAS will have to step in to adjust the exchange currency rate so as to make our export still competitive. Yeah. How long will that take effect? Probably I would say weeks or within several months.
So the Fed rate has consistently shown patterns. Now, in the past 3 cycles, it has dropped more than 2.5% within 12 months. In fact, there are some cycles where in 18 months it drops 4.8%. So that's a bit extreme. On the most conservative basis, we believe that the Fed should drop at least 1.5%, causing our Singapore floating rate SORA to drop from 3.6 to maybe 2% as well.
Now is also a good time to start shopping for a new housing loan, especially if your lock-in period is ending soon.
If you are trapped in the lock-in period or you have some penalties or clawbacks, you have to wait till it ends. Those who have the ability to refinance in the next 6 months, please take a look at the choices available today. So 3 months before your lock-in period ends, that's when you should start shopping, because you need to give your old bank 2 months notice, and you also need to shop and have processing time. So altogether 3 months before would be a perfect time. 4 months before is okay as well. But once you skip past 2 months, that's where it's a bit too late. You still should refinance, but you will incur some charges.
With interest rates set to fall, choose a loan package that gives you the flexibility to adjust to lower rates later on.
There are packages in the market, right? There is 1 year fixed, and second year is a floating SORA rate, which is very, very good. It's still locked in for 2 years, but it guarantees you that you are only fixed for 1 year and you're in the floating rate for the next year. So there's a bit more uncertainty in the market. I mean, we just came from a high, so people are scared to be like, oh, second year float, that's a bit scary. There are also packages in the market that give you 2 years fixed rates with an option to change to a floating rate on the second year. So you pay a bit more of a premium there, but you get the flexibility. So these are rates which we recommend to clients today. Don't take up 3 years fixed rates unless certain necessity happens, like it's an investment property.
While interest rate cuts are good news for borrowers, they may not be such good news for savers.
When interest rates are low, people are more inclined towards finding new instruments or ways of making more returns. And some of these instruments, they tend to come with a bit of higher risk. Yeah, so if your risk level is not high and you are being exposed to such instruments, you will have to adjust your expectations along the way.
Experts say a cut in interest rates generally mean you can expect lower returns on lower risk investments. In Singapore, these include options like T-bills and Singapore savings bonds, which have been popular in the past few years of elevated interest rates. But with yields trending downwards, should you try to lock in rates while you still can?
I mean, there's no perfect answer to that, you see. It very much depends on the person's goals and what they are working towards, as well as their risk tolerance and comfort level. Definitely, if you're looking at 6 months to 1 year, T-bills is a very good option. Yeah. For SSB, the good thing is that it's liquid. So even if they were to put in, for example, like a 10-year SSB, but along the way, if they need to redeem it, there's no penalty. Yeah. It's also good to diversify your assets. That means have sufficient assets into these instruments to protect your short term. Yeah. However, if you want to plan for mid to long term, these instruments may not help you to fulfill that kind of returns that you're looking out for in the future.
Market watchers don't expect the Fed to cut interest rates by more than 0.5% in the first instance. That means you still have time to take advantage of high interest rate savings accounts.
High-yield savings account, people do like it because part of it is safe, and secondly, it's liquid. Yeah. And most of the time, to allow you to get a high yield, the things that you're doing on a regular basis, example, spending money, example, putting money, crediting your salary into it. However, do take note that for high yield, the interest rate is it's not fixed. That means it may be adjusted depending on how the bank's discretion. And also secondary, there is a cap to the amount of the money inside that has access to the interest rate.
Unless absolutely necessary, try to delay big purchases that may require you to take on a new loan.
Start of this year, a couple of banks are actually cutting the interest rate. So there is some form of trickling effect. Yeah. So now if we foresee that rate cuts may potentially go down, then why don't we just hold it off a while? Maybe you can have a wait and see kind of attitude. But during wait and see, you can do all the legwork first. Yeah, that means you can talk to people. If you want to purchase a car, a house, talk to your property agents, talk to your car dealers, just to understand a bit, yeah, because they would have more information, yeah, with regards to how the market is moving. Then from there we can take a cue, whether we want to execute now or whether we want to execute maybe in the near future.